Mind the gap, there's still 1.7 million more unemployed Americans now than there were in February before the pandemic. The rate is 1.1% higher than it was then. And the hardest hit sectors saw the most gains. Leisure and hospitality, obviously they're coming back, they led the way. But even so, 1.5 million fewer jobs than in February last year. And the manufacturing rounded out the top three for job growth. Julia Coronado is founder and president of MacroPolicy Perspectives and joins me now. Okay, take this number, and now, bearing in mind the Fed had a really good idea what was coming down the road on this and others, does their decision on tapering make sense, or should they have done more?
Should they have done more in terms of going faster on tapering?
Yes.
No, they should not have done more. This is a sign that the job market is coming back. This was their expectation. We lost some momentum. We still have a ways to go. They do think we can recoup not just the jobs, not just the unemployed people who are actively looking for work, but a lot of the people that have left the labor force. Haven't seen that yet, but that tends to lag the decline in the unemployment rate. So we still have several miles to travel here, Richard, and the Fed, meanwhile, is steadily, gradually taking away that support. And by mid-June next year, we should have a much better picture of what the post-pandemic labor market and economy looks like.
Okay, so when's liftoff in your view? I know you've got to get tapering down, and I know there's got to be no longer reinvestment of existing runoff of securities. But in your view, when does liftoff happen?
So we still have liftoff penciled for the first half of 2023. We think that a lot of these we're about to go through a bout of intense supply chain and energy inflation in the winter months. Then we think it will subside, and that, again, the labor market will be humming along. Keep in mind that we've been surfing this epic fiscal support package that is slowly, gradually fading. Consumers still have a lot of cash in their accounts, but it is going to slowly, gradually fade. Growth is going to slow. We do expect a good transition because the labor market is really strong, but we're not going to be growing at the rate that we've been growing this year. And that should ease some of these supply chain.
People like you told me time and again that by the time inflation is there, you're in trouble. And it's usually too late to do anything about it. Now, these transitory elements of it as a result of supply chain. Look, to give you an example, my next guest it will be the Norwegian governor of the Bank of Norway. Now, they've already raised rates. The Bank of England took everybody by surprise by not raising rates. The debate in the ECB is, should they raise rates, even though President Lagarde is fighting a rearguard action. Isn't the Fed in danger of being behind the curve?
No. And I think, in fact, I think that the Fed is very intentionally being behind other central banks. We've been through cycles where the Fed has tried to be the front line of tightening, and things don't go so well. The Fed is the keeper of the global reserve currency. They are moving in the same direction as other central banks in terms of removing some of the accommodation. It's the right direction to go in. But if the best practice for the global economy is for the Fed to go steadily and methodically. Other smaller open economies like Norway, like England, they face a lot more pressures through their currency, and they might have to be more nimble and respond. The Fed and the US have the luxury of being able to move steadily and slowly. And in fact, it's best for everybody else too. So I think it's an intentional and deliberate decision to be behind other central banks in terms of the tightening push.
So when we look at markets, for example, we'll probably end up at a record. I mean, there've been records all over the place. And how do you, and I realize there's a perversion in the relationship frequently between markets and the real economy. And we often see this blown out, and perhaps are seeing it at the moment. But how do you square that circle with economies that are, a US economy that is not fully back on its feet, with markets that are absolutely enjoying the fruits of easy money?
Well, let me just say that this is one time when actually markets are a good barometer of the real economy. We spend so much time talking about inflation without talking about the fact that this is demand-driven inflation. In addition to the supply chain bottlenecks, this is first and foremost a strong recovery. The US grew 6.5% in the first half of the year. The jobs are coming back faster than any of the last three labor market recoveries. This is a profits. Profits are breaking records, Richard. Profitability is high even despite rising labor costs. The rising tide is lifting all boats. And what is the key to all of this? Productivity. COVID served as a catalyst for forcing companies to adopt a lot of business transformation projects, doing things better, more efficiently. So productivity numbers look really good. The stock market has every reason to be happy. Earnings numbers have been strong across many industries. So will it stay that way is the bigger question. Will companies still be able to navigate through these supply chain issues, solve those problems, sell those products? Will they be able to find the efficiencies to lower their labor input given rising labor costs? So far, a lot of really impressive gains have been made on that front. So I think in this case, actually, maybe we have the narrative wrong, fretting and wringing our hands about all of the bottleneck inflation, when in fact, the real economy has performed impressively well.
Julia, we need to talk more about that in the future, Julia. You raise a very good point that I hadn't fully factored in on this program. The productivity gains as a result of COVID changes of working will only now start to become evident. It's something we need to explore again with you, Julia. I'm grateful to you. Thank you.